And you may have heard about bank failures, high inflation, and rising interest rates a lot in the news over the last few weeks. I work to provide some insight in all the confusion. Gas, groceries, and the cost of living have had drastic price increases in the last year. Phoenix Metro consumer prices are up 8.5% since February of 2022. There is always a constant level of inflation, and the federal government likes to keep that number around 2%. So what is causing all the rise in inflation? Experts credit part of the problem to a fall in the labor supply and other supply chain issues. I spoke with Timothy James, a professor at the Global Futures Laboratory, to better understand this problem.
The other factor is the global supply chains broken down to some extent as a result of COVID, but also the geopolitical events in the Ukraine and Russia.
But what is the federal government trying to do about it? The Federal Reserve has raised interest rates steadily over the last year in the hopes of increasing the cost of borrowing money and by decreasing people's spending power. Think mortgage payments, car payments, and credit card payments. It also limits how businesses can use that same money to grow and expand.
The way that the central government operates to try and control inflation is sometimes known as a one-club golfer. They've only got one tool, and that is what's called monetary policy, i.e. changing interest rates.
Last week, the Federal Reserve raised interest rates by 0.25%. However, the Federal Reserve is dealing with a lot more than the interest rates. Earlier this month, 3 banks across the nation failed in a short amount of time. How did this happen? When you deposit your money into the bank, it will use that money to finance loans to other people and businesses. If people start to get wind that their cash is not secure, they often flock back to the banks to withdraw their money. If the bank does not have enough money on hand to give back to depositors, they must start quickly selling or liquidating their assets, often at a loss. If there is not enough cash in the bank for depositors, the bank fails. Banks often loan money to each other, so if one fails, it can cause all the others to fail too. Then their customers will try to withdraw those same funds.
If the bank is big enough, it can affect the whole banking system.
The Federal Reserve and the Federal Depositors Insurance Corporation, or FDIC, can step in and cover a portion of a depositor's money, usually up to $250,000. However, the feds say depositors of those 3 banks had access to all their money starting March 13th. It is a part of the Fed's effort to instill confidence in our banking system and avoid more failures. So what else are they doing? They're making additional funding available for eligible banks through another funding program. This will ensure banks can meet the needs of their customers, and the hope is that all these actions will prevent more failures and keep your and my money safe for the future.